Another week and another record on Wall Street. The Dow, S&P, and NASDAQ all hitting new lifetime highs this week. But are the markets getting ahead of themselves? And is a pullback inevitable?
If anybody knows the answer to that, it's our next two guests. Joining us now, Monness, Crespi, Hardt Managing Director Steve Kroll, and Morgan Stanley Wealth Management Managing Director Shelley Bergman. Shelley, I'll start with you. It's an obvious question to say how much longer does this rally last, but let's just put it this way. Markets too exuberant or right on the money?
Well, Liz, it depends upon what market you're talking about. I think in the United States, there's certain sectors that are being priced for perfection. I think if you look overseas, though, some of the international developed markets, some of the emerging markets, you could find a lot of stocks trading at much lower multiples with a lot better dividend yields than here in the U.S. So, yes, there are sectors in today's market that are fully valued on anticipating that Trump's going to bowl, say, a 300 game. It's not going to happen. So we are waiting for pullbacks. You haven't had a 5% correction in 6 months. I think you got to have some cash on the side and be globally diversified right now.
You know, Steve, before we started the segment, the four of us were talking about the old Wall Street and just the old show and just how we've all been in the business for so long. If I had watched the press conference on Thursday, before that press conference, and I got to see it, and then I said, all right, I can actually set up my positioning before that Trump press conference, I would have thought the market would have had a violent reaction. What is going on that the market seems immune to almost everything that historically the market cared about?
Well, I think the honeymoon is starting to wear a little thin, and hopefully the marriage with the president and the public will last longer. But I think that, as Shelley mentioned, I think that we are due for a 5% correction. It probably started yesterday. But, you know, valuations are okay, but a little bit stretched. And, you know, a couple of months ago, we were worrying about earnings and Brexit and what have you. Now we're worrying about something different. We're worrying about North Korea. We're worrying about Russia. We're worrying about Chinese currency. And obviously, some of the Trump situation is a worrisome. If you look at his four programs, the first two, immigration and regulation, I think he can take care of. The health care is going to be harder, and most important, tax reform. I think in going around the country, I think it has delayed a lot of projects because they don't know what the number's going to be. So if tax reform doesn't get done until 2018, we may go through a couple of months of or a couple of quarters of slower GDP. If you notice yesterday, the economic data was good, but the bond market rates came down a lot.
Well, you've got surging consumer and business sentiment. I think consumer confidence is at a 12-year high. I think as you look at this, people and investors, and you've got a sophisticated audience watching right now, that bet against an increasingly stronger market have gotten hurt, at least in the short term. But, you know, you saw the Catalyst Hedge Future Strategy Fund. They had bearish bets. They lost $600 million kind of in the blink of an eye. So what signs are you looking for that moment of tipping point to the other side?
I think as long as you're properly diversified and you got global diversification, you can't time this market. I mean, let's just take the last 12 months. Last January and February, you had a 10% correction, and everybody said the bear market is upon us. Right back to new highs. You had the Brexit situation. Market went down 5 to 10%, right back to new highs.
Buying opportunity.
Buying opportunity. Then you had, right into the election, everybody worried about Trump getting elected. You had 9 straight days down, 4.9%, first time in, they say, 20 years. Wasn't a big percentage, but it was 9 straight down days, and then the market ripped. Yep. People have been uninvested in stocks now for the last 5 to 10 years. They're afraid now of missing this rally. And that's what's really going on here more than anything. So what I suggest is stay globally diversified, go in places that haven't moved, keep some cash on the side, and don't try to time this thing.
All right, to be fair to Shelley, he did join us a year ago on the program when everybody was hating the market and wanting out of stocks, and he implored people, long-term investors, to invest.
Goodbye.
You actually talked about the fact that there was a lot of private equity, publicly traded private equity firms that were severely undervalued in the public markets. Big acquisition this week, SoftBank, $3.3 billion for Fortress. I know you're a holder of Fortress. What do you think of the publicly traded private equity firms now? Does that still present a good value?
Look, we like them. They've had big, substantial moves over the last 3 to 6 months. They pay good dividend yields. If you're going to see some of the policies put in place that Trump has telegraphed repatriation of cash, lower tax rates. You saw an announcement this morning that Kraft was going after Unilever. You're going to see a lot more M&A. You're going to see a lot more cash in the system. We think interest rates are lower for longer, which is going to keep cheap money around. That should be very good for M&A, be very good for valuations. And the private equity firms in public form, and there are a lot of them, should do very, very well.
Steve, your best ideas right now, knowing what you know about a few question marks and whether the Fed is less powerful today than President Trump is.
Well, I think the Fed will raise rates in March because the numbers have been good.
That's a big call.
That's a big call.
And it may lead to the 5% correction that may come. But I think, as Shelley pointed out, the big issue is there's only one place in the world to go. Our rates are low. They're going to creep up. Earnings are pretty good. You stay with the stocks that are doing well. I love the airlines. I love the housing. I love the banks on a pullback because after the Fed increase in March, you may have a 2 quarters where the Fed kind of takes a holiday.
I can't see the Fed moving in March. Deflation is still being exported around the world. And so that, I think, would be a real negative for the market. Do you think there's a shot the Fed moves in March?
I don't know whether the Fed's going to go in March, April, May. I don't think it matters.
Yeah.
Yellen has telegraphed that she's going to do 2 to 3 interest rate hikes. Whether it's March or April, it doesn't matter. Pay attention to the 10-year, pay attention to the 30-year, and pay attention to the dollar.
What is the bond market telling you right now? What is the bond market telling investors? Because it's telling me that the equity markets are way ahead of themselves in terms of growth expected.
No, I think the bond market is telling you, based upon where the 10-year is today and where the 30-year is that growth will be subpar. And no matter what policies Trump puts in place, you're not going to get that 4%, 3% GDP growth. We're not going back to the 80s or the 90s. Okay, consumer spending is a lot different than it was before. Technology, job creation, all of these things are changing the way that the economy moves. And once again, it's going to be very, very, very hard, okay, to see an economy take off.
Yep.
I am concerned, and my big concern is the Fed goes too fast and the dollar starts coming under, I shouldn't say coming under, if the dollar gets significantly stronger, I think that's going to be a problem.
That might be a tough alchemy to work with. Steve, you like to look at price-to-earnings ratios. There's the conventional wisdom that we're at a perfectly priced market or maybe a little too expensive. What is your level that you don't like to breach when it comes to PE ratios?
Well, the two numbers are 17 times on this year's numbers, but it's 23 times on a GAAP basis. So you have to be fair on whether you're doing apples to apples, and a lot of companies are using the non-GAAP numbers, which I don't really like because you're not expensing certain things. So that part it makes the market slightly overvalued.
Shelley, Steve, thanks for joining us here on Wall Street Week.
Great to have you.